Okay, and in this week's podcast episode, the title is Are You Ready for Entrepreneurial Wealth? And I'm so thrilled to introduce Pete Fernandez, Managing Director and Wealth Partner at J.P Morgan Wealth Management, where he serves ultra high net worth investors. For the past 20 years, Pete and his team have supported business owners and entrepreneurs throughout their entrepreneurial journeys, before, during, and after liquidity events. Prior to J.P. Morgan Wealth Management, Pete held SVP and Principal Wealth Management positions at UBS, Private Wealth Management, and Bernstein. Pete's path to wealth management began after a 17-year career in the professional services field, where he held several executive positions and served as a public company officer. He has been involved in the sale, purchase, and turnaround of 3 different businesses, giving him first-hand experience of the challenges faced by business owners. Pete, this is great, man. I mean, you and I go back decades now, right? We met when we were much younger, and you've been a tremendous friend, tremendous advocate in the community. I can only just welcome you to this show. This is fantastic, Pete. I'm thrilled.
Thank you, and thanks for having me.
Yes, and as an extra plug, thank you for mentoring my boys. All right, thank you. You've done a great job there. Thank you. So, Pete, let's kick it off then. This is all about that entrepreneurial group, all right, coming into some significant wealth. And you said to me, business owners are different. So, Pete, what makes them different than traditional wealth management clients?
Well, the biggest difference is that business owners have historically run their own shop. They've had a high degree of control over a business. They direct it. They're very clear on what they want. They're very clear on what they don't want. They're exceptional at managing risk in their business. And all of that translates very differently to the wealth management arena. They're not, by any stretch of the imagination, passive. So it's a very different cohort of wealth management clients. They're accustomed to running a business, leverage, other business aspects.
We're gonna get into the nuts and bolts of that. Thank you for that introduction. All right. So, why are liquidity events, Pete, such a pivotal moment?
Well, typically what happens is a business owner, has a liquidity event. But prior to that, they know where they're going every day. They're walking into their office, they have a game plan. We often think that business owners can see around walls because they really understand their industry, their business, the levers to push, and so on. And while they're running this business, it's very clear what they're doing day in, day out. And then suddenly there's this business that liquidates, and there's a deposit into an account, and now they're in essence running a totally different business that they know nothing about, where they have a lot less control, where they're really lost sometimes, where they don't know what to do next. So that sense of purpose that comes with a business is suddenly transformed and changed, and it's a big surprise for many of them.
Absolutely. And the loss of control, I would imagine, the entrepreneurial mindset, I've come across many of them in my career. They're visionaries. They may not necessarily know how to convert the vision into real, actionable execution points. And many of them want to maintain tight control. But in terms of what you've seen in your career, Pete, in terms of their willingness to hand it over to a wealth advisor, what have you seen? Just give us a little sense of that.
Yeah, sure. That's great. So obviously, the first thing that you get into is they're skeptical. They're skeptical of the capital markets. They're
Yes.
skeptical of a market that they often don't understand. For example, a company will announce record earnings and record revenue, but the stock will go in a different direction for other reasons. So the trick there typically is not to just jump in with both feet, but to educate themselves first on how these things work, what they look like, what the different instruments are. And then over the course of time, as they begin to get their arms around what the capital markets mean, how they work, how they function, get used to seeing their accounts with the daily volatility. It takes time for that to happen. It takes sometimes 6 months to a year for them to be more comfortable, assuming that they haven't already been doing that before.
And I guess it's the try before you buy. I mean, is this in kind of gradual, staggering milestones, Pete? Is that the way you kind of see it play out?
Well, I think it's, look, I'll give you an example. With bonds, it's very simple to understand a bond. They have a coupon payment, there's a maturity date,
Yep.
there's credit. So that's very clear and very defined. Equities are a whole other beast because those move around a lot. So typically what you'll see is that an entrepreneur will start very conservative
Yep.
because it, they already got their grand slam, right? So the objective is not to go out and hit another grand slam. The objective is to preserve that capital and grow it.
Yep.
So, and to generate income from it. So that does take time. Not everyone is comfortable right out of the blocks going to a higher equity allocation or other instruments. And it does take time to become accustomed to that. Usually by the time several years are in, they are accustomed to how these work, how they function. They're beginning to look at more opportunistic areas. And that assumes that they're actually comfortable with other types of risks. They'll often invest in bonds on one end and then invest in their ventures on the other.
Got it. Got it. All right, Pete. Beautifully said. All right. So now we're going to get into the key wealth considerations, right? So let's set the stage, Pete. Could you provide an overview of the key wealth considerations entrepreneurs face before and after a major liquidity event?
Sure. So for the number one issue that we're often solving for that people forget about is that here you have this company and you're about to sell it. And the first question that comes in day one after the sale is, can I afford my lifestyle? And
Yes.
if so, what type of lifestyle does that look like? So it's great if it's a number that's just so large where it just doesn't matter. But oftentimes it's somewhere in between, right? So there's a lot of calibration that needs to take place because what an entrepreneur hears in a transaction is, I sold my business for $90 million, 100 million, or 50, whatever that number might be, and they forget that there's this thing called debt repayment. They forget about taxes. They forget about the transactional fees, and by the time they're done with it, they're often surprised that that number is a lot smaller than they thought it would be.
Yeah.
So it's really calibrating that before so that once the deal is closed, that they're in a good place. And
Yeah.
if there's excess or surplus capital, that's great. So we often tell, entrepreneurs, first thing you've got to do is calculate that core capital so that you understand how you're going to sustain your lifestyle.
Got it. Got it. Okay. All right. So now let's talk about sources of capital and making the deal. So when entrepreneurs are contemplating a major liquidity event, what are the primary sources of capital typically that they should be considering to ensure a successful and profitable deal?
Sure. So there are multiple buyers out there in terms of people that would have an interest in a business.
Yeah.
Obviously, one scenario is that you've got employees that want to take it over and you're comfortable with it. That usually becomes an ESOP,
Yeah.
and that's one source of capital. That is one avenue to go, but oftentimes in the more typical ones are basically financial buyers, be they private equity firms or whatnot, or strategic buyers, which are businesses that really have an interest in filling out their repertoire in terms of their company and the products they offer. So those different sources of capital come with different terms, each of them. I'll focus on the private equity is usually a financial buyer. They're very interested typically in having that entrepreneur stay on board. They're very focused oftentimes on rolling over the equity so the entrepreneur has skin in the game. And that is a big consideration if an entrepreneur is going to sell their company and then roll equity into something else, well, that technically is at risk. In the case of a strategic buyer, a large, let's just say a large public company, you're often looking at potentially having some stock that's awarded as part of the transaction or the consideration. And there may be some milestones that come with additional stock grants. So again, it's a question of what those mean and how they translate to that core capital that I was talking about, and excess capital if it exceeds the core.
Got it. So Pete, the rise of the family office, where does that play in this ecosystem? Both, as a form of, liquidating your company, but also you hear a lot of entrepreneurs who will come on this wealth and will say, I want to establish a family office. I want to do the kind of investing. So I know we'll get to some of that bit later, but just touch on the family office and where it fits in the ecosystem.
Sure. So one other buyer, which I didn't mention, but you're correct, or partner really, in the case of a family office, there are families that have come from entrepreneurial backgrounds that want to bring their wherewithal to a business that they like and bring those learnings as well as their capital. And they're often much more patient in terms of how they view businesses. In other words, they may be comfortable holding a business for 10, 20, 30 years. They just want to invest in that business because they view it as an opportunity and just part of their portfolio, if you will.
Yeah.
So that's one avenue that is available and out there. Very different type of buyer in terms of what they're looking for and looking to do. As far as when an entrepreneur sells and establishes a family office, that term has been quite overused because a well-structured family office, if you look at it, is in essence you're establishing a new business. So think of what's actually going on there. You have an entrepreneur that maybe was great at making widgets for plumbing or irrigation, whatever it might be, and all of a sudden they've established a business called a family office, which is focused on investments and wealth transfer and all these other things that, frankly, they don't have a lot of education on most times.
Yeah.
So in order to do that well, you have to have people in that staff or on staff that have trust and estates experience, institutional investment experience, accounting experience, a variety of things. And that isn't always there available. And the smaller it gets, the harder it is to get highly qualified people that can actually do that. So that's oftentimes that's where the leverage comes in with a wealth manager as someone is building out a family office. There's a lot that we've done that we've already got that scale. So that's one of the areas that we often play.
Understood, Pete. Thank you. And so just to wrap this piece up about sources of capital making the deal, any sage advice you can offer in terms of those options and the optionality an entrepreneur may have as to, where that capital comes from, prospective buyers, whatever. Any sage advice as they're leading up to that particular moment in time, how they should look at the market and how they should look at which avenue may be of interest to them?
Yep, I think that each of those has a very different complexion in terms of the relationship that business owner has with their existing business,
Yep.
and what that means with whoever bought them out. So I think one of the areas that business owners often struggle with is the fact that they've been acquired and they're now an employee ostensibly, as
Yep.
opposed to true business owner.
Yes.
Yes, they still have a 20% stake, but that other 80% is pretty vocal about what it wants, needs, or is going to do. So, and that often flies in the face of what most business owners think. So, what I would say is that when an entrepreneur is considering an exit, they really need to think about that part of it, of what's their willingness to stick around after the deal, and their understanding of where they're going to sit in terms of the food chain of decision making, and what latitude they're actually going to have or not have. And that is one area that I think I've seen time and time again where someone says, well, they bought me, I'm going to become the lead of XYZ. Well, that doesn't happen. And that's a totally different discussion on the breakup. So
Here, Pete, I can't resonate, more on your point there, because having been in the kind of M&A space and acquired companies and all that kind of stuff, that's one of the biggest thing, particularly with the smaller entrepreneurial organizations. It's, the willingness to, continue, the motivation to continue, all right, cultural change in the way they did things. And, that post-acquisition period is typically can be a dangerous period, right? I mean, you could lose earnout ability, you can lose profitability and all that kind of stuff based on the mentality of the seller.
and usually and oftentimes the entrepreneur is working off of instinct and experience.
Yeah.
And many times the buyer doesn't have that instinct or experience. And what that means is that a decision-making process that involves consensus becomes really the forefront. It comes to the forefront, and most entrepreneurs I know just can't deal with that.
Absolutely. Reporting to other people, approval processes. I've had entrepreneurs when I've gone into businesses and acquired them. Excuse me, what's a budget? What's a plan? What's a forecast? Why do I need to do that?
Exactly.
All right. Okay. So uses of capital. And entrepreneurial ventures. Let's move to that, Pete. So beyond personal lifestyle, entrepreneurs often reinvest in new ventures.
right?
Share some insights, Pete, on the strategic use of capital for entrepreneurial endeavors post-liquidity event.
Sure. So I'll tell you, there's actually a cycle there that's kind of interesting, and it repeats itself over and over again. The Somebody closes on a business. The first use of capital is a car, sometimes an airplane, usually a new house. Sometimes they change their lifestyle in terms of spouses, and then they so that's the first thing that typically happens, is that you see within 6 months is all these purchases of things they've always wanted, and in many ways it's collecting trophies for, monetizing years and years of experience, right? You then get to this income phase where I now want to have income that's more conservative, and then we get to the phase that you just talked about, which is now I'm sitting back, I've sold my company, I'm now on sabbatical, right? I'm past my earnout, I'm now on sabbatical, and I'm bored. What is that business owner good at? They're great at building businesses. They have great contacts, and usually the first thing they think about is, well, how do I go out and deploy my capital and my social capital and political capital
Yeah.
for the benefit of another business? So they begin to seek out other businesses that they can come in and impact. And the places where I've seen that works best is when someone stays within their lanes, meaning if they've been in the healthcare industry and they go back into the healthcare industry, there's usually a higher probability of success. When an entrepreneur veers away from that and goes into another industry because they feel that they have all this unusual entrepreneurial skill, I would say that those probabilities go down pretty substantially and sometimes disastrously. And then the part that becomes a big risk, frankly, is that an entrepreneur many times feels like, look, I've got the best idea out there. I know what I'm doing, and will continue to put capital into a venture that, frankly, should be dead. And and where that becomes challenging is if you invade that core capital that I mentioned, that's used to fund lifestyle for the benefit or for the use of this new business. Well, now you're beginning to play a totally different game. Now you go from wanting to work to needing to work, and that's been a pretty interesting process for some people.
Absolutely. So, Pete, we'll veer a little bit more into psychology. This is not a podcast about psychology, but you mentioned lifestyle changes and, people even winning the lottery and then losing, the money the next day, etc. In your travels as a wealth manager, what advice would you give people from a mindset standpoint? They come across $100 million, all right, and things sometimes go wrong in that second chapter or that next mountain. What's the mindset, would you say, is probably the most devastating to actually go into that second mountain, or that they need to watch for as they enter this new wealth?
And so I think it's an interesting problem. What
Yeah.
typically happens is someone gets an inordinate amount of wealth, and now I've actually had somebody tell me before, I don't know how to be wealthy, right? So they think that being wealthy means that you have to buy a ranch in Montana. It means that you need to have a 90-foot boat. It means all these things, and usually those come with big price tags.
Yeah.
So, a plane is a great example. I mean, I can't tell you the number of times somebody said, "Well, I want to buy an airplane," and you sit down and walk through the economics of an airplane. Say that's pretty expensive. Every time you go up, you're burning capital. You're not investing capital. You're burning capital. So I'd say the first thing that people need to do is just make sure they don't get caught up in I'm suddenly rich and now I got to be rich, or affluent. I guess that's the more proper term. And that's usually where people get themselves into trouble, is their spending rate goes wildly out of whack with the assets they have. And it doesn't matter what scale you're at. It could be someone that just got 20 million, someone even that got 300 million. We've had to have complex conversations with people at those levels where we're having a conversation around, you really can't afford to be doing this with this airplane every single week. I mean, it's the amount of money that's going out the door is insane. So I'd say that's something that is a big caution. And usually when you cross that line of, we call it I've heard this best expressed, that core capital is the Napa Fund, Never Is Poor Again Fund.
Yes.
It's not core capital on the side. You'll sustain a lifestyle. The minute you begin to invade that with high spending or bad investments or whatever it might be, you're basically making a decision that you will probably have to go back and rebuild the wealth.
Brilliant. Love it. Okay. All right. Legacy planning and generational wealth transfer. So it's obviously a crucial aspect of the entire continuum here. What strategies do you recommend for entrepreneurs looking to establish a lasting legacy through wealth transfer to future generations?
Sure. I think that's there are two aspects of that. There's the financial aspect and there's the family dynamic side.
Yep.
So when it comes to the financial side, there are a number of strategies that can be used to transfer wealth from the first generation to the second generation.
Yep.
And just to be clear, when you exceed $13.6 million of net worth, everything above that for an individual today is taxed at 40% upon death. So $100 million estate where 13.6 is pulled out, that 87 million or so, 86 is taxed at 40%. That's a $32 million tax bill, right? So it's really important to understand, how much is going to be transferred as part of a transaction and as part of that wealth. The harder part, which I don't know an entrepreneur that doesn't struggle with this, is the whole concept of, well, I've just transferred all this amount of money to my children who are not prepared to deal with this wealth. And there are a number of approaches to be taken there in terms of making them responsible citizens and earning their way towards that wealth, if you will. And that is a very challenging part of the process. There is no single answer there. There are no two families that are alike, but it's important to start early and often so that they respect the wealth of the family. Many families will go through and articulate what the purpose of the wealth is in their family and what it should be going forward. And inculcating those values comes in many forms. So, for example, being appreciative of that wealth may mean that you have your kids work with different charities in the field feeding homeless, as an example. So there are many ways to get there, but it is by far the number one issue for people that have had this kind of a transformational financial event.
So Pete, when should the entrepreneur start thinking about this? And, if they're seeing some type of, transaction in a year or two, and we'll have the conversation about when you think is the right time to start planning for that.
Sure.
Who do they go to? Do they go to Pete as a wealth advisor at that stage? Do they go to, the attorneys? Who do they go to as to start to think about, I'm coming into all this money, I'm thinking about the family issues and the generational wealth, and that transition process. How, in what advanced period should they be thinking about that, and who should they be going to?
Typically, that's a team of people.
Yeah.
And oftentimes, we definitely serve as that quarterback because what you find very quickly is that there are multiple facets of
Yeah.
wealth, and oftentimes those disciplines that are underneath aren't talking to each other. So, for example, an estate planning attorney may not be talking to the CPA, who may not be talking to the wealth manager who has the picture of on the broader level. So I think the general answer is earlier is better than later,
Yeah.
as early as possible, because these are not questions that you solve in a minute. I mean, this is not a business decision making process where you put up this nice little chart, you put up a bunch of factors, and then you somehow figure out the answer is X. I'll give you a perfect example. We have a client that was, talking to their daughter about a car they're going to get, and the question came up: what's the appropriate car to get this child of this several $100 million business owner or net worth business owner? Should she be driving a Ferrari or should she be driving a Volkswagen? Right, and that was a source of contention in the family. The wife in this case said, well, she should be driving a nice car, and the husband said, or the entrepreneur said, look, no, she's got to earn her way there, right? So there's a lot of that kind of decision making that goes on when it comes to wealth. The Definitely an estate planning attorney is usually one of the key people that's involved.
Yeah.
because they understand the structure and the dynamics. The wealth side, I think the advantage is when you sit in our shoes, you usually get to see a lot of different examples of what's worked, what hasn't worked, where the issues are. And it's like anything else in life. If you can tap that experience, it just benefits you.
Got it. Are there any popular or kind of non-negotiable instruments, Pete, that you've seen if someone's coming into that type of wealth, annuities or particular type of trusts that you would want to kind of talk about at this point?
Sure. So typically with on that side, it usually involves more the estate planning attorneys than anybody else.
Yep.
Beyond, I'll give you an example. For example, there are certain things like qualified small business stock that help you do certain things, from a planning standpoint. If if you meet the definition of a qualified small business stock, but the instruments that you typically see are that prior to a transaction, you can value a business at a discount, and you can make gifts or sell those shares to your children at a highly discounted rate, which means you transfer that much more wealth. The earlier you start that, the better,
Hmm.
because the valuation of a private business is much more fungible early on. But if you get to the point where there's a hard offer on the table, the purchase agreement is signed, the IRS basically begins to look at it and say, wait a minute, that $10 per share price that you were talking about is really 20 because there's a purchase agreement that says that. So
And the valuation at a discount, which professional should they be seeking that independent kind of advice or valuation?
so typically there's two folks involved there. One is an estate planning attorney that's looking
Yeah.
at the actual company and so on, and doing the valuation from an estate tax standpoint, right? Not a market valuation, meaning
Yeah.
would the business trade. And then the other side of that is there's typically a business valuation expert, again, that's focused on the estate planning side that determines what the value of that business is given the prevailing market at that time. Meaning just assets that are out there, not the capital markets, not the market for buyers.
Understood. Understood. Perfect. All right. That's awesome. All right. Let's move on to the continuum now. Still on legacy planning, but now philanthropic impact. All right. Many entrepreneurs coming to wealth and, they've got a purpose outside of, business, so to speak. So they're passionate about giving back. How can wealth managers guide them incorporating philanthropy and creating a positive impact as part of their legacy?
Sure. I think, look, there's, again, I would say this bifurcates into the instruments that are available and then the actual activities that go against that. So, as far as instruments, there are foundations that can be established where an entrepreneur would contribute to those. There are donor advised funds that are a little bit easier to run if you don't want the complexity of a foundation. There are also other instruments like charitable remainder trusts and charitable lead trusts that allow you in different ways to provide assets for your children while also providing a benefit to the charities that are involved. And they have some other attributes that allow them to or enable you to do certain things. So, for example, if you wanted to diversify a concentrated stock position, some of those instruments are better than others. Okay. But when it comes to philanthropy, what I found with business owners is that there's generally speaking, I'd say two or three evolutions here, right? One is gratitude. Oftentimes, if someone's made a large sum of money, they're grateful for that. They understand that other people were involved. They will often look at other people that can benefit from their generosity, and they'll just find ways to give directly to those causes, right? Um, the other thing that tends to happen is when they're business owners, there's more of a venture philanthropy approach, meaning, I'll give the charity $1, but I want them to match it, two times, and I want it directed at this particular outcome, and I want reports on that outcome, right? So you do get some of that, sort of a flavor from the business owners. And the last is depending on how, and this comes with time and comes with what I'll call multi-generational wealth or dynastic wealth, is there is a point where an entrepreneur or business owner is later in life and they say, look, we've got to figure out how we make the world a better place.
Yeah.
And they may have a view of how that should take place. So they may even create their own charity that, contributes to other charities, or frankly starts a new area that never existed before. And all those together go into the family dynamic side. So what we found there is most people that give, philanthropically, want their children somehow involved, because they want to make sure that their children understand this whole generosity and gratitude side of the business, right? I mean, we found some that use philanthropy for business purposes.
Yeah.
Maybe I round up all my friends. We contribute to this thing, and next thing you know, I've got a construction contract, right? But generally speaking, it's the former.
Got it. Got it. You mentioned charitable remainder trust and lead trust. What's the difference between the two, Pete?
Well, in a charitable remainder trust, it's exactly that. There's a remainder that you put an asset into this
Yeah.
trust. It, at the end of it, gives the remainder to a charity,
Got
right?
it.
And then you get income coming back in the other direction as the grantor, the person that established a charitable remainder trust. A charitable lead trust is a little bit different. What it does is you've got an asset that you put in that pays the charity along the way, and at the end of it, your beneficiaries, your children, would have assets that are there. So they're instruments that can be used for multiple purposes. They have multiple, benefactors, if you will, or beneficiaries. Sorry, but again, it's just a matter of, does it make sense for that particular situation or not.
Pete, part of the mission of this podcast video series, in addition to growing profitably and maximizing value, but it's also for a greater good. With the entrepreneurs who kind of get to that next mountain and understand a purpose and making the world a better place. Let's go down to the psychology a little bit again. How do those typically, with that psyche and that mindset, how do those typically fare after, coming into all this wealth in their lives? I mean, give some of your kind of history and, some of your relationships.
On the psychology of post
Yes.
sale.
Yes.
Look, I think it's a very daunting step, which
Yeah.
people don't readily understand, right?
Yes.
For 20 years, you go into a business, you know everything about it, you see people report to you, you've got all these resources available, you know what you're doing from push this lever and I get that kind of income.
Yes.
Everything's clear, there's a purpose. Literally at 8, you wake up at 8, at 8:30 you're at work, right? Now you sell this asset, right? And you got this giant pile of money. First thing that happens is you end up finding a lot of friends that you probably don't need,
Yeah.
right? A lot
Yeah.
of people start reaching out. I've actually heard people tell me that they feel like a target because they go from being an unknown to a press release goes out with their name, and suddenly everyone wants to be their friend, right? So there's the first part of that, which is just I'm done with all the flies that are coming around me. I want to focus, and usually they're trying to bat these away, right?
Yes.
Then there's this purpose that comes in. What do I do next, right? I mean, I can't sit around all day. So usually it involves some activity, golf, fishing, whatever. Not for everybody, but they're sitting around and realize like all their friends can't do the same thing because they're the only ones worth $100 million or 50, right?
Yes.
So they very quickly realize that they've got a problem with purpose. What's my purpose in life?
Yeah.
That many times will become taking care of grandkids. It may become something along the lines of traveling around the globe. If you've never been able to do it, you now have enough money to do it. Why wouldn't you do it? Right. And so there's this loss of identity that takes place, is probably the way I would describe it. Of, I used to be this really big business guy, and now I'm wealthy, but what does that really mean? And then there's this whole idea of, well, and what am I trying to do for the rest of the world, for my family, the kids? So it's not easy. The investment side of it is even more intimidating because there are more ideas there than probably there should be. There are people of varying skill, uh, people of varying what do you call it, subjective as it relates to that business owner, what they want out of them, if you will. So I think that that is a very, very difficult period to navigate. Now, what makes that easier is, again, understanding post transaction, what is that going to look like? I'll give you a perfect example. I remember there was an entrepreneur that we work with, and very capable CEO. So he sells the company. The next day, there's no IT department. Right? Where am I getting my health care?
Yeah. Yeah.
I mean, the simple things in life that you take for granted, of the
Yeah.
server's
No.
not working, call IT. Well, IT
Yeah.
doesn't exist anymore, right?
Yeah.
There's those sort of things that they typically grapple with. So
Yeah. Thank you, Pete. Brilliantly said. And if a person, because you mentioned the big P word, which is purpose, if a person basically is able to bridge the mountain, first mountain to the second mountain, and that's usually about making the world a better place or philanthropic, etc. Do you find their journey easier because they've got that purpose? There's probably a lot of passion behind it. They prepared themselves for this particular point in time, rather than potentially those who may not be or may not have the purpose or may not be philanthropic. Tell us what your views on that.
yeah, I think it really varies because, look, entrepreneurs define purpose in different ways, right?
Yeah,
Um, if that was an entrepreneur that was involved in the biotech space, creating new drugs and therapies and
yeah,
whatnot, and they go make the next, or they go focus on the next one, then there is a big purpose, right? They're
yeah,
trying to help the world in a different way.
yeah,
I would think that most entrepreneurs that I know think of one of their purposes in life is to grow businesses and build them and so on. And arguably, when they do that, there are a number of people they're helping in the process because they're keeping them employed, they're doing
yeah,
things of that nature. That platform gives them the ability to execute on that purpose in different ways,
yeah.
right? Gives them a bigger voice sometimes, in terms of what they can actually get accomplished and do. So I think that helps a lot. There are very few people I know that have no hobbies, and some of those that have no hobbies, their hobby is business,
Mhm.
right? So
Yeah,
so but I do think it is kind of a challenge because serial entrepreneurship and growing a business and getting it to a level of where other people value it the same way is not easy. Doing that twice, definitely not easy, right?
absolutely.
There are exceptional entrepreneurs, but that's not to say that every entrepreneur that steps into a venture succeeds on every single venture. There are failures in between there sometimes.
Absolutely. All right. Beautifully said. Thank you, Pete. So the big T word, and we're talking about taxes now, estate and income tax considerations, right? Now you mentioned some of the estate tax threshold and so on, but so clearly it plays a significant role. What proactive steps can entrepreneurs take to manage estate and income tax implications effectively while ensuring maximum value retention?
Sure. So I'll give the standard disclaimer that I'm not an attorney, I'm not an accountant,
Oh,
but I've seen a lot.
absolutely.
um, Look, the first question most people ask is income tax, right?
Yep.
That's usually the number one uh, topic when it comes to a transaction.
Yep.
And the problem is, if you're just sitting on top of a transaction, meaning it's about to close, there's only so much you can do. So I would say that the best way to get there is you have to talk to your accountant and a tax attorney to figure out what is the best way to structure an asset,
Yep.
before you sell that asset.
Yep.
Now, everybody that I know does not want to pay taxes, or I should say, they prefer to pay less than more. I've not met anybody that says I love paying taxes. So it's really that minimization needs to take place early. Otherwise, it's just too late. There's certain things you can't do at the last hour that are just not going to work. On the estate tax, that one's a little bit different. The problem with so income tax. I mean, let me just back up. Income tax is pretty clear. You got to
Yep.
have a CPA. You got to have a tax attorney. This is an asset. If you structure it this way, it's a capital gain. If you structure it that way, it's not. And obviously, the less in capital gain and the more offsets you have, the better, right?
Yes. Yep.
and that's pretty straightforward. Estate tax is a different beast, and I'll tell you why. The mechanical part of it is not hard. It is not hard to figure out that you should have a lower value on an asset that grows outside of your estate when it's sold for a larger value, right? If I can take a $5 asset, move it out of my estate, and then it grows to 10, that extra growth grows out of the estate. It's not subject to estate tax. The problem is that most entrepreneurs I've met feel that they're immortal. So, they're either immortal, they're never going to die, and why would I ever deal with that? Or the flip side is you're talking about some very heavy stuff, which is what do you want to have happen when you die?
Yeah.
And now I have to start thinking about, well, I've got 3 kids. That one's really smart. That one's not that smart. That one's married to the wrong person.
Yeah.
How do I want to deal with that? What are the challenges and the issues? And so think about this. You're running a business, and that's pretty much the last thing you want to deal with. Most people don't want to talk about their death,
Yeah.
right? So that is one of the challenges, is that, and I've found on a number of cases that you're pushing people to, maximize that part of it, but they don't want to go there because it's complex. There are strategies that you can use to move assets out of an estate early on between spouses, but that brings up a whole other set of questions around, well, do you have marital harmony or not? And
Yeah.
what happens if after the fact something changes, right?
Yeah.
So these are things nobody wants to discuss. Is like, well, I love my spouse, but how do I know there's not an impending divorce 3 years from now? Or, how do I know I'm not ruining my kids by transferring all this money? So I would say the mechanical part of that's very easy. The hard part is just the dynamics of just thinking through all the eventualities that could occur.
Absolutely. Okay. All right. Let's move on to keeping what matters in your asset base, right? So after the deal, asset preservation, Pete, becomes crucial. What strategies do you advise entrepreneurs to employ to safeguard and grow their assets in the long term?
Sure. So I think asset preservation, I guess there's 2 elements of that. Again, one is the unwanted creditors. So,
Yes.
and the other one is really the flip side, which is the financial asset side of, you've got assets. So the unwanted creditor one is one that, and anyone that lives in South Florida knows that you can go down the street and probably pick up 10 to 12 personal injury attorneys within the first block of I-95 or wherever it might be. Right? That's probably the case everywhere else in the United States. And so the worst thing that happens is, especially if you have a very unique name like Richard Outram, is that a company is sold, a press release goes out.
Yes.
Richard just sold for $100 million, right? And now, that's someone's gravy train for the rest of their life, because guess what? They might be throwing themselves in front of your car, right? So
Yep.
there's 2 ways to solve that, generally speaking. One is through, transferring that risk to somebody else in the form of like an umbrella insurance. And
Yep.
the second is to use a legal structure that really asset protects those assets, right? So I think that's something that we're often looking at and saying, look, and by the way, if something really bad happens, they're going to find a way to get at the money, or those assets. So it's more a question of how to make that process harder or more difficult for the unwanted creditor. Um, by the way, another unwanted creditor is if you have children, they're married to the wrong person. There's a way to protect them from having some sort of a marital asset by using a trust that basically is only for the benefit of that child and is never for the benefit of anybody else. So that's the legal side of it. From
Yep.
an asset standpoint, an investment standpoint, I think this is one area that's very unique with respect to entrepreneurs. In our experience, entrepreneurs operate on a preserve and grow model.
Yep.
Meaning they've spent 20 years building something. They don't want to see those assets decline. At the same time, they want a maximum level of return.
Yep.
That does start to push you into different types of assets that have a different complexion to them. So, for example, there are instruments available that protect downside against downside events, for option based, et cetera,
Yep.
that can be used in that regard. And so those are always a consideration depending on what somebody wants to do, but very different way of looking at capital on that side for an entrepreneur.
Got it. Got it. Wow. Okay. All right. Lifestyle, spending wisely now, Pete. Lifestyle considerations are often a top priority, and you mentioned this earlier. What advice do you have for entrepreneurs in managing their lifestyle and spending to ensure financial sustainability and fulfillment?
Yeah, I think we've covered that several times.
Yeah.
And I'd say the number one thing is knowing what it means to have core capital. And core capital is I've set aside a certain amount of assets to generate income, and you stack that income on top of other sources of income. So, for example, if I own a CVS triple net and it generates 5% income to me, as an example, well,
Yeah.
that's a good starting point. And then you add what you would make off your other assets and then continue to do it that way, right? So you're really trying to get to this pool of assets that's serving the master on that end. I think as far as lifestyle, look, it's very easy once you have substantial liquidity to spend a lot because there are a lot of really good things in this world to buy. And I don't think that anyone says, I've worked hard for 20 years and I'm not going to live like a monk.
Yeah.
Right? The real question is, and by the I don't think it's a budget thing where you tell somebody treat them like a small child and say you can only spend $100,000 a month. That's your limit. The reality is that's fungible. It moves around. 1 month it's 60, the next one's 100, the next one's 40, depending on who it is. Yeah. So, but as long as it stays in a range, it's okay, right?
Yeah.
Within the range of acceptability. Once you start getting past that, not a good thing. So,
Got it. Got it. Okay. Let's talk a little bit about sabbaticals now, because taking a sabbatical is after a major deal is common. It's a common consideration, right? How can entrepreneurs use this time wisely? And what financial planning should accompany this period of reflection and relaxation?
so the I'll tell you that the most challenging period for us as wealth managers usually is the following, right? Deal closes, earnout. So now the person's
Yep.
focused, earnout's done, and sabbatical begins. So the first thing that happens day one of the sabbatical is they immediately start looking, they being the business owners, immediately start looking at their portfolios and watching it day in, day out and looking at CNBC. And by the way, before that, they're looking, but they really don't look at it that hard, generally speaking. And suddenly they're fixated on every single movement. So my experience is the first 3 months of that is pretty rough
Hmm.
because you're getting accustomed to going from a defined income source called, earned income to an undefined income source called capital markets,
Yeah.
right? So that's problem number one, right, on that end. The second thing is, like you said, it's sabbatical. So it depends on what the hobbies are. Generally speaking, I found that varies. That's there's a wide spectrum there. Some people love to, have different pursuits. Maybe they wanted to be a car racer when they were a kid, and now they're suddenly, in a car club, right? Others want to go fishing all the time. So I think it's a matter of, dialing into that. But ultimately, all of those have a thirst for entrepreneurship. And what I would say there is a lot of times they've got to be very thoughtful about what they're going to do next. And that period of introspection, really, what I would say and recommend to an entrepreneur is they really need to understand what happened the last time. Were they lucky? Were they good? Where were they good? How were they good? What were they not good at?
Yeah.
Where might they have some open spots?
Yeah.
Because where they usually get into trouble is venture number two. I've got this great idea. It's not. The first $1 million is easy. The next million is harder. After that, they start, depleting capital, but they still have a lot of conviction. And the good and the bad of an entrepreneur is that they're used to winning under all circumstance. So they've done something unique and exceptional before. So sometimes they just don't know how to stop. Am I going to
Absolutely.
stop out? Am I going to stop after I've thrown $2 million at this idea, or do I just double down, right? And now it's 4 million. Do I double down again? When do I cut this thing off and just take my losses, right? So
Absolutely.
they would never do that with a stock, right? Where you say, well, I bought the stock and it tailed off, and let me put even more, and then keep putting more and more and more, and then find out that they ended up with zero, right? So I think that's where people get into trouble is they sometimes, I think, over exaggerate or over understand their productivity and success. It's called the By the way, it's called the lottery effect.
Thanks,
There's
man.
actually an area of behavioral finance called where they call the lottery effect, right? You go up to the slot machine, first time you win, second time you win, third time you win, you say, well, I'm really good at slot machines. No, you just got lucky. The fourth time you get wiped out, right? There's a reason the casino's winning a lot, right? So I think I would say that definitely pervades the mindset of a business owner.
Before we get into the final stretch and talking about mistakes and pitfalls that you've seen, Pete, with all the principles we've just discussed, are those the same principles for sports stars and celebrities, or are there nuances?
Well, those are sports stars and celebrities have a little bit of a different complexion to them because there are often people involved, agents or
Yeah,
business managers that are involved. In the case of sports stars, typically there's a very finite period of time where they're sports stars,
yes,
and
yes,
after that, after that they got to figure out what chapter two is.
yes, yeah,
And
yeah,
even if they were the best sports star, that a 40-year-old basketball player is having a harder time than a 20-year-old basketball player, right? So to the degree that they have some longevity in their careers, it's great. But as you know, this is very ephemeral. A celebrity can be in today and out tomorrow and back in 20 years from now, but there's a period in there that's very dry, right? So I think it's the same problem in the end, which is if you have a pool of capital and it serves a purpose of income, you better know and understand what that pool of capital is and not invade it, right? So and the same thing. I mean, you got the same problem of, well, at what point do I just say, look, I'm never going to make another movie, or I'm not going to play another game, and there are no more endorsements, or they went from big endorsements to smaller endorsements. Our team doesn't work as extensively with athletes and entertainers, although I'm very familiar with that situation. So
got it, got it. Brilliant advice, Pete. Thank you. All right, let's talk about mistakes and pitfalls. So, what are the biggest mistakes that entrepreneurs make in the continuum leading up to a liquidity event and afterwards?
I think the number one issue is they wait too long. They wait too long to start the planning process, and by
Yeah,
that point, there's no opportunity. So you can't structure yourself the right way for the income tax side. You
yeah,
can't do the right estate planning, so you have limitations of what you can and can't do at that point. So if they were to, a third piece I would say is they really don't think about the day after, right? What's what's that going to look like, and am I okay with it? So what will often happen is you get a preemptive bid out of nowhere. Someone shows up and says, I love your business. I want to buy it. It's a big number. It's an attraction to that number because everyone gets wowed by that. And now you're, 5, 6 months into this process. You spent $1 million on fees, and then realize that, you know what, I just don't like day plus one, what that looks like. Well, you could have saved yourself $1 million, right? So I've seen that happen before. Or, the flip side is I thought I was going to get X, it's now Y, and I can't afford to live off this. Right. So had that happen too. That happens with smaller businesses, generally speaking. But my experience is that the liquidity event and the value that's created is often in sync with the spending.
yeah,
Usually, if you're getting 100 million, you're spending something analogous to $1 to $2 million or
yeah,
more a year. If you're getting 50, it's some multiple of that as well, or 20.
yeah.
So those two follow each other. It's the same problem, just a different order of magnitude.
Got it. Got it. So I wanted to encapsulate just a few, as you mentioned in the course of our discussion here. The lottery effect is one you mentioned. Rushing into wealth management rather than taking their time and getting it right. Spending at the next level up, you mentioned that early. Assuming business acumen equals investment acumen. That's a good one, Pete. I love that one. An unrealistic expectation for returns.
Right. The unrealistic one is we haven't discussed as much, but absolutely. The one of the biggest ones is, look, the reason you're getting paid all this money as a private business is because there's an inefficiency there that you're taking advantage of,
Yeah.
right? Typically.
Yes.
And you should get paid more for that. You should get paid more for the risk that that entrepreneur is taking. It's just
Yes.
that risk is equal, the reward is equal to the risk you're taking.
Yes.
But
Yeah.
many entrepreneurs don't see it that way. They say, well, it's not that risky. Well, no, it's risky, right? The bank could pull the line, the business could go upside down. I mean, there's all kinds of risks that are usually out there. When you get to the capital markets, the public markets, that's an incredibly efficient market. There are, multiple analysts covering a security. Everyone knows what they're looking at. The information's available. Everything is audited 8 ways to Sunday. So by definition, that's less risky. The
Yeah.
only difference is that's marking to market every second of the day, whereas a private business is not marking the market. So the perception is that this private business has no volatility. No, it has a ton of volatility, as indicated by the wide dispersion of bids that you get when you go take a company to market, right?
Yes.
But you're not going to make the same kind of returns out of the public markets that you would make out of the private markets for obvious reasons. So that, by the way, great catch on that. But the expectations are wildly out of whack
Exactly.
often when you get to that.
Love it, Pete. All right, final thoughts about sustainable wealth. What are the pieces or the final piece of advice or wisdom you would offer entrepreneurs for building and sustaining wealth that goes beyond the initial liquidity event?
Look, I think they just need to understand what a business owner needs to understand is you've been successful in a business that you know everything about that business, how the functions, dynamic, etc. And to think that you're going to walk out of that into a world that has complex trust and estate structures, right? Complex instruments, securities that you think you may know, but you don't, you know, and that you're going to easily succeed. I mean, you've started a new business, you just don't know it, right? That's the issue. And I just go back to every time I've heard this statement where someone says I'm really good at business and I came out of the oil industry. I know everything about oil, and now I'm looking at ConocoPhillips, and it's a great company. Well, it's a great company, but it doesn't mean that it's a good investment,
Right.
because that could be a terrible investment. It may be expensive. It may have balance sheet issues. But they're a great company. They produce a lot of goods, right? So I think that disconnect between great business and great investment is what gets people in trouble. And they think, hey, I'm a good business person, I should be really good at this side of it. Yeah, there's some correlation, but it's a different animal. I mean, there are thousands of people in this industry, if not hundreds of thousands or millions. And I often am surprised that, just the breadth of the industry, right? So to think you're going to come into this and just master it in 1 second is not going to happen. And you can be at it for 20 years, which, for example, I've been in this industry for quite a while, several decades, and I still look at things and go, wow, that's different and new. And I didn't see that coming, or we saw that coming, but didn't have a way to play it, whatever. So I think that's the one thing I would say is you're starting a new business. You don't know it.
Wow. Brilliant, brilliant advice, Pete. Pete, thank you so much. You are a consummate professional. You're clearly an expert in wealth management. Just like explaining the continuum and what entrepreneurs need to look out for was just simply fantastic. I know you'll empower entrepreneurs to maximize value in their business for a greater good, and that's absolutely fantastic, Pete. So thank you so much indeed.
Thank you, Richard. Thanks again.
Awesome. Thank you.